Welcome to the Investors Trading Academy event of the week. Each week our staff of analysts and educators tries to provide you a better understanding of a major market event scheduled soon, and that will have an effect on the global markets. Nearly 7 years ago, the Fed put its benchmark interest rate close to zero as a way to bolster the economy, and for months now officials have said they might raise rates by the end of 2015. Recent statements underscore an intention to act at their final meeting of the year in December. It's a liftoff, to use the Fed's own term, that's getting the kind of attention that space aficionados once lavished on NASA rockets. Fed officials left rates unchanged after the meeting in October, but when they do make their announcement, it will have lasting consequences. The last time the Fed raised interest rates was in June 2006. The forthcoming decision of the Federal Reserve on interest rates is a humbling example. Consider that after 7 years of virtually 0% short-term interest rates, the Fed Open Market Committee is almost universally expected to raise rates slightly at its December 15-16 meeting. What this means for the markets isn't clear, however. We can't rely on historical precedent. The last time rates rose after remaining very low for so long was in 1941. That was a long time ago, and when there has only been one previous example in very different circumstances, historical statistics won't prove much of anything. There are other ways of analysing the likely effects of the Fed actions, but all have severe limitations. First, logic tells us that if short-term Treasury rates rise, low-risk Treasury bills may become more attractive in comparison with riskier alternatives like stocks. That suggests that stock market should weaken because people will become even more wary than they may be right now about share prices, which have tripled since 2009. Home prices should weaken too because rising interest rates can be expected to make mortgages more expensive. In other words, this line of thinking is quite negative about the general effect of a rate rise on market prices. There is another way to look at this though. If the Fed raises rates in December, it could be seen as good news because the Fed won't take that action unless it viewed the economy as relatively strong. That could buoy market prices. This approach immediately leads to further complications. Good news about the economy might be bad news about inflation, which tends to rise when economic growth picks up. On the other hand, if inflation rises, even if the Fed raises rates slightly, the real or inflation-corrected interest rate might actually be lower, not higher.